Yep, we're going to break it down to a 4-part. You point there, you point there. Yeah.
Tongue-tied.
Oh,
Welcome to 772 Living with Lisa.
alrighty. First of all, if you are here on our third video, thank you. Apparently, we haven't bored the crap out of you. And if you're new here, welcome. I'm Lisa Ammons. I'm here with Bryant Stuckey from SWBC Mortgage, and we are talking about mortgage lending. Oh, yeah! Oh, it's so exciting stuff. This is video 3, and we are going to be talking about getting to the closing table and the process that is involved in getting to closing. If you have not watched video 1 or 2, I will certainly in the description box below put a link to both of those. Check those out. You might want to go back and watch those first if you're just new to lending, and then segue to video number 3. It may be helpful to you. And today we're going to be talking about, as I said, closing. Okay, so let's talk about what happens once you have your pre-approval. You know, everyone's all excited because we're getting ready to close on the house. And it is the best part of the mortgage process.
Yes,
is
it
getting
is.
to the closing table. So once your customer gives you all of their financials, what else happens to get that person to a clear to close?
Okay, well, it is typically in the lending world, we call it a two-touch process. Up front, we've already collected all the paperwork, the income documentation, the assets, all that good stuff. That we already have, so that we can send that in once you're under contract and get all of those items validated and checked off by an underwriter. That's where our underwriters come into the play.
Right.
You know, we collect it, we look at it, we review it. 9 times out of 10, we agree completely, but the underwriter is the ultimate say-so that checks off on those items. So that's typically your first touch. The second touch is, the next part is, you're under contract. We're going to get your appraisal ordered. We're going to get with your title company. There's going to be a survey ordered.
Okay.
And we're also going to need an insurance policy. That needs to be added in and collected. You know, up front, we're going to put an educated guess on what we think the insurance policy should be, but then we have to actually have an insurance policy in place. So when we close, we know who your insurance agent is, we know exactly how much the policy is, so we know how much to collect to pay that first year of insurance at closing.
Okay, so once you've got all your documents in, your appraisal, your title insurance, your survey, an insurance binder, all that goes to the underwriter and they bless it?
That's it. That's the second touch. So the first touch takes care of all the income, the assets, the paperwork that we've collected up front. Second touch takes care of the extra items that come into play after that process. So first touch, reviewing the documents. Second touch, reviewing your appraisal, your survey, the other things that need to be done once you're under contract.
Right, and then we get those 3 magic words, clear to close.
That's it. Everybody's favorite 3 words, because you know it's done.
Ears. Yeah, that's right.
Okay, we have the lender working with the title agent because we have some numbers and they have some numbers. So we put it all together on what's called a closing disclosure so that we can have final, actual numbers that you know the final number to wire for your closing. Now, timing of this closing disclosure is critical. According to law, sadly, it's not opinion, it's law, we have to have this closing disclosure to you as the buyer, and it has to be acknowledged 3 business days before you can close. So we want to make sure you're available, you're around, the numbers are accurate, and everybody's happy 3 business days before you can close.
Okay, so let's talk about the wire.
All right, a wire is the way that you're going to have to send the money necessary for closing to the title company. No longer can you bring a check. You can't even bring a check, a cashier's check, or a money order. A wire is the only way the money can be sent for closing.
And the reason for that is criminals have gotten very savvy. They counterfeit cashier's checks, money orders. They will even spy on your email. So because you do have to wire, there are some precautions that you have to take prior to making that exact wire.
Absolutely. You will be given wire instructions, typically by email, from the title company that's doing the closing. When you receive those wire instructions and you go to your bank to send the wire, while you're at the bank, call that agency to verify that the account number, the information given of where the wire should go, is accurate.
Yeah.
So a phone call to the title company will always cover you in that event.
Always pick up the phone, always call, and get a verbal verification that the wire is correct. Now let's talk about where the money is coming from.
Doesn't happen that often, but the money for closing does need to come from one of the accounts that we validated for you. So if you have your bank account from Bank A, then the wire for your closing needs to come from the money in Bank A, not Bank B or Bank C that we didn't know about because we haven't validated that those accounts are actually yours and that the money coming from those accounts is yours.
So at the last minute, you decide you want to split it up into a different savings account that you didn't share with your lender. You can't do that. It needs to come from the account that you disclosed initially up front. So this is some really good information. Now, Brian, some of the people watching might be considering purchasing a second home, and they actually might be considering purchasing a second home with money from an investment account. So we're going to kind of dive into that a little bit. So if this describes you and you're considering a second home purchase, you might want to watch our next video, video number 4, which I will put right up here, where Brian and I will be discussing second home purchases and using money from either retirement or investment accounts in order to make those purchases.